Hey everybody, it's Erik Torenberg, co-founder, partner of Village Global, a network-driven venture firm. And this is Venture Stories, a podcast covering topics relating to tech and business with world-leading experts.
Hey everybody, we're now accepting applications for our Network Catalyst Accelerator program. Founders in our program have gone on to raise money from Lux, Spark, A16Z, Slow, First Round, SUSE, Homebrew, Mavron, Obvious, NFX, Signalfire, and many more. Learn more and apply at villageglobal.vc/network catalyst. Hey everybody, welcome back to another episode of Venture Stories by Village Global. I'm here today rejoined by two very special guests, Taylor Pearson and Gabe Bassin, back for round two. Taylor, Gabe, welcome back to the program.
Thanks for having us.
Yes, sir. Thank you.
So we're here to try to make sense of everything that's happening. Why don't we start with the Fed versus the Treasury? Who's doing what exactly, and how exactly is money coming into the economy?
Obviously, there's a lot of moving parts to this one, and there's so many different programs. They keep changing things and adding and subtracting, and as a small anecdote, just someone trying to apply for the PPP, which isn't even a Fed program, but it's a federal program, but it's just changing constantly. The rules are changing. What can be included, what can't be. Same with all these programs they're doing, and so it's in terms of what the Fed's doing. I mean, they're doing a lot. I think as a broad stroke. I mean, there's an alphabet. I mean, Taylor and I have talked about it before. There's like an alphabet soup of different facilities. They call them programs, et cetera. At a high level, they're basically trying to, backstop liquidity. So they're trying to backstop liquidity through these programs, whether it's the commercial paper funding program, the CPFF, or the municipal lending program, which is backstopping municipal bonds, or the Main Street lending program facility that's going to backstop small business loans, or the secondary and the primary corporate credit facilities, those are the ones you're hearing about. People are kind of cynical about because they're buying corporate bonds and junk bonds as well. And there's money market lending facilities that is going to backstop money markets. And so, the Fed is, it seems like primarily trying to just make sure the system stays lubricated, for lack of a better word. And the thought being that if they're signaling that they're there to lubricate the system, and that they are actually in the markets, doing certain things, backstopping loans, providing loans, buying ETFs, et cetera, that will cause, the rest of market participants to kind of, take a deep breath, look at the system, think the system's okay, and maybe be willing to either, buy things themselves, purchase, take loans themselves, so on and so forth. So there's an explicit kind of thing going on with them actually providing money and providing loans and being buyers in the market, as well as an implicit thing that it's like, oh, the Fed's there, and there's this kind of implicit guarantee. And so I think that prevent, their goal from all those programs is to, prevent the worst case scenario from occurring, which is complete seizing of the system. No one can get loans, margin calls, people forced to sell assets at bargain basement prices, which causes even more, selling pressure in markets, which causes even more margin calls, which causes, that kind of vicious cycle that can occur in asset markets when there's leverage. And I think that's primarily what they're trying to do. Sorry for the long-winded answer there, but there's a lot going on, and I barely touched the surface there.
Well, I know it's like the way because we talked about this a little bit, Gabe, the way based on your script on Turkey, right? It's like there's these rolling liquidity crises as sort of there's some, I don't know if unwinding is the right term, but as these liquidity crises from hit different industries, they're basically just like rolling out new programs into those industries. Just as you said, like try and keep things lubricated. I mean, because I don't understand. I know we talked a little bit like what is the distinction between what the Fed is doing and what the Treasury is doing. And like that.
So what ends up happening, again, my understanding is that the Fed is setting up. There's these SPVs, these special purpose vehicles that are being set up that are basically the Treasury puts money in as equity to the SPV, and then the Fed levers it up, X amount of times, 5, 7, 10 times, depending on the asset. And so then that special purpose vehicle, is then the facility that is then the vehicle that is buying the assets or giving the loans, et cetera. I think it's kind of akin. Again, I don't want to get too in the weeds, and I'm certainly not an expert with all this, but like similar to kind of like the Maiden Lane SPVs that were set up for, that were backstopping the Bear Stearns asset-backed securities back in the day. That there's all these different kind of vehicles that I think help. There's probably some legal reason for structuring it in that way, but the point is that the Treasury puts in the 10%, the first 10% of the equity, and then it gets levered up. Puts in all the equity, but then it gets levered up X amount of times, and then they go and do what they do.
Yeah, I guess one of the things I was wondering, so the question is is the Fed constrained in terms of how much leverage they can add to those SPVs? Could you get a run on the bank scenario where whatever's in those SPVs, even at 10x leveraged, isn't enough to provide liquidity systems? At that point, does Congress have to re-inject? Do they have to pass a bill to put more money into those SPVs, or how does that work?
It's a good question. I don't know if I even know the answer perfectly, and they could rule change. But my understanding is that, kind of, again, goes back to the implicit versus explicit. I think implicit in this is that the assets in those SPVs can only degrade so much because they are in the market buying, and because they are implicitly guaranteeing so many things in the system, especially these assets that they're also explicitly buying, where they're literally going and buying those assets. To have a run on those assets, you need the rest of the market participants to kind of panic, to be selling assets, down, and that's not impossible to happen, where the Fed owns a bunch of loans that they're buying, just kind of, I don't want to say just randomly, but they're buying a bunch of loans, and then and the rest of the market says these loans aren't, these are no good, these things could go to zero, and then they sell them down, and then that causes what you're talking about, Taylor, like the equity in the SPV to degrade to a point of insolvency, and then what happens then? Does the Treasury just re-up? And my guess is yes, and I think so. I think, again, they're trying to make it so hard with these explicit and implicit guarantees that all right, you're going to go, the rest of the market's going to panic. We're not going to let the market panic, because we're going to provide all these guarantees, and we're also going to be there with a bid at 90, even though the market wants to sell it down to 80, we're going to be there at 90 to bid it. And then that signals and also provides capital. But again, you're right. At some point, if these loans are so bad and they're worth 10 cents on the dollar, well, and then if that happens en masse, well, then it's a problem. And yeah, they're going to need to reload. And that is definitely something I think is going to have to happen, because of things we may have talked about before, some of what we're seeing in some of these markets still, and we mentioned commercial paper is one of them. They're still kind of functioning as if the Fed has not guaranteed this stuff, has not guaranteed the solvency of a lot of these products, and isn't there backstopping it. And so even with these explicit and implicit backstops, some of these markets are somewhat dysfunctional, and commercial paper being one of them, which is a very important market, because that's where companies fund a lot of their short-term liquidity needs, 30 to 90 day type stuff, a lot of working capital. These are unsecured kind of short-term loans, is a good way to think about it. And the point is that there's a program, a facility that we talked about before, the CPFF, commercial paper, funding facility, I don't know, something like that. And, they're there to backstop that. And even with that guarantee by the Fed, companies are having a hard time issuing commercial paper right now. It spreads are wider, interest costs are higher than they should be, given the Fed's there. And so to me, it's not that relevant that, Johnson & Johnson's can't access the commercial paper market, or has to pay 3% for 90-day paper, or whatever the number is. That's not an actual number, but it's more just that overall there's stress in the system if the commercial paper market, is trading at such high spreads. And so it's more emblematic that there's going to be more help needed. There's going to be more of the bazooka is big from the Fed, but I think it's going to need to be bigger. Now these things can tame and these things can settle down, and maybe we'll see that. I mean, the CPFF, the commercial paper facility, just launched this week, and so probably maybe we'll see some improvement and see what happens as they're out there kind of actually buying or willing to buy commercial paper versus just saying they're willing to buy. And so we'll see what happens. But the point is that there's it's not all, even though the Fed is throwing gajillions of dollars at this problem, at this liquidity problem, they're doing their best to stay ahead of it. But to your point, Taylor, all of a sudden XYZ industry starts to get weird. Well, are they going to start backing energy companies? Are they going to start backing, specific industries, specific facilities for specific things? And, at what point do they say, well, what are we going to, we can't do everything. But they're trying.
You mentioned the bazooka thing, like the Hank Paulson line from, I think it was pretty saying in front of Congress before TARP in 2008 or whenever it was. Like that there's that game, I guess you call it the game theory dynamic, right? It's like not just what are you doing, but like what does the market credibly believe you can do? And like if you can convince them everything, then like that you actually have to, if you can convince them you can do more, you actually have to do less, right? Because it's credible if you have a bazooka in your pocket. But I guess going back to the commercial paper, I wanted to, so when you say like the spreads in commercial paper, normally the commercial paper trades at a slightly higher interest rate than the risk-free rate of like U.S. bonds. Normally that's what, like 30 basis points or something, and now it's like 200 basis points. Or like what? Like how out of whack is that?
I don't have the exact numbers in front of me. I don't have a Bloomberg, but it's trading much wider than it does. I don't have the exact. First of all, you can look at each individual company and see where those trade, where Johnson & Johnson's and where General Mills and where, Exxon, et cetera, their commercial paper trades. And you can look at that on an individual basis. You can also look at an index on Bloomberg, but it's trading, probably 50 to 150 basis points wider than the risk-free rate or whatever it is. And, in theory, it should be trading around the risk-free rate because, again, the Fed is guaranteeing it. So, you basically have the Fed's credit or the treasuries as your counterparty in the worst case scenario. If for some reason Johnson & Johnson defaults on their commercial paper, well, then you get your backstop by the Fed, the Treasury, et cetera. So why are spreads not kind of converging to, it doesn't necessarily not going to necessarily be the risk-free rate, but closer than where it is.
Weird. Yeah, like it does. Like I don't know, you're like loaning Johnson & Johnson money for 90 days, and not like which like it seems like Johnson & Johnson's probably pretty creditworthy on a 90-day time frame, and the Fed says even if they're not, we'll make up your money, and like still spreads are much wider there than they are historically. Like I guess that is like an interesting thing. And you said you don't like it's also. There's people that are flooding into that market as well. Like there are some people that are kind of saying, oh, okay, like I trust the Fed. Like there's kind of when we talk about, like there's a schizophrenic character in a way almost, right? Like there's two parties, one of which is sort of like back in full risk on mode, and one of which is like I don't kind of trust this.
I forgot what I was going to say, but yes, I agree with everything. I agree with everything you said there. It's a bit wonky. It could be just some kind of, I don't want to say technical, but kind of a technical situation where the typical buyer of first of all, commercial paper is unsecured. So even though it's like 30 or 90 days, like you said, it's unsecured versus a bond, which is secured. So that's a nuance. But again, you're talking such short-term paper, in relatively high quality companies, or the highest of quality companies in these cases that we're talking about. So it doesn't need to be secured. And so you're actually seeing capital structures shift right now as people are not willing to finance commercial paper. They're not willing to invest in the commercial paper market, but they're willing to invest in bonds. As you saw a few weeks ago, and even recently, the corporate credit money inflows is off the charts, near some of the highest weekly inflows in terms of bonds, but also in terms of new issuance, in terms of companies getting loans bonds, etc. So there's investors willing to buy bonds in size, but they're not willing to play in this market. And again, it could be a function of a lot of things, but it's wonky, which again leads me to believe that, either maybe my time preference is too high and I want things to, I want to be able to know the answer now, and, and over time things will settle down and the commercial paper market will come back, and slowly but surely, through the signaling effect, through the actual effect of them being in the market, everything will be smooth. But as of now, I'm just, it's a little bit concerning, even amidst the NASDAQ now up on the year, whatever, it is, S&P's down 30%. And, here we are again. It's not to say that the market's going to collapse tomorrow either because of this. It's just that, it makes me scratch my head. It makes me think twice before, getting too excited, even amidst the equity market price action at this point.
Yeah, I've talked to a fair number of volatility traders over the past few weeks, and one of the things I've heard from a lot of them is that their sense was a lot of the declines in the major indices that we saw in March was more of a institutional degrossing or deleveraging, that you had the example that I'm familiar with or somewhat familiar with is there was you can correct me on this, there was a carry trade between U.S. Treasury bonds and the futures, and so there was a 30 basis point or something like that arbitrage there, and so you had these funds that were levered up 30 or 50x or something that were doing that arbitrage. So they make at 30 basis points you're not making any money, but at 50x leverage on 30 basis points, now you're making real money. And then what happened when the Fed started to cut rates was all that got wonky, and you have all these highly leveraged players who had to degross their books. And then, as you mentioned, you have these kind of liquidity cascades, right? Someone gets margin called and becomes a forced seller, and that pushes the price down. And then the incrementally next weakest hand gets margin called and they sell, and you keep pushing that down. That was interesting to me in terms of the commercial paper market, just because that narrative is basically the fact that we had the largest global supply and largest global demand shock, I don't know, maybe ever. I think probably ever. Yeah, that hasn't been as much of a factor, just as the leverage and stuff. And so I don't know, I'm trying to square how that goes with the commercial paper, even the right narrative or.
Yeah, I mean, that is a good point. And it's I think you're right. That was a huge accelerant or, huge reason for kind of what went down there. And, the demand shock, if you mean aggregate demand, is that what you mean? In the economy?
Yeah. People aren't spending money.
Yeah, right. And exactly. And that the jury's out, right? We don't know where we're at on that. I mean, if you look at the market, is forward looking, and look, the market's, where above where it was a year ago. The NASDAQ is, I don't even know where it is on the year, but it's back to almost, I think it might be up or something. I don't know, but so it's, if you looked at these kind of forward looking indicators via the stock market for, you'd think, yeah, this is the market's basically saying this is a temporary demand shock. This isn't going to last that long, and that we're going to kind of, add back, and kind of, or take it out, because we know that this was just a one-off or something like that. And that's, certainly arguable at best. I mean, again, if you think about the ripple effects and you think about what Main Street's going through, and you see the bread lines, and you see, not to get too dramatic, but just, you see just the psyche and the paradigm shifts that are occurring right now, and how people are living, and how people are working and living their lives and spending money, et cetera. I don't think that's a 1, 2, 6 fix where we're just, here we are, one quarter and done, and, we're just back off to the races again. It's possible. I mean, and then given all the stimulus that we're getting, even though, again, I'm on one hand saying it's not enough, but we're getting a lot of stimulus, nonetheless. You could say with all that stimulus, with all that backdrop, if it's just a one-off, well then, yeah, great. But it's just hard to see, especially given what we don't know about the kind of future path of lots of things, the virus. We don't need to talk about all that because that's been talked about a lot, but just, what are the effects on that? What's the supply side effect on that? How does that affect supply chains? How does that affect production? So on and so forth. And so, yeah, I think it's hard to, we can opine on it, but it's just really hard to know, is this one time in nature or not? And it depends, we can look at different markets to kind of indicate what we think. And you look at the stock market is saying, oh, this is a relatively one-off-ish event. At this point in time, again, on April 17th, 2020, the market just bounced, I don't even know the numbers, 25-30% off the lows from late March. As of now, the market's saying this is one-off. This is short-term in nature. But if you look at some of these other markets, the bond markets, the treasury yield curve, the euro-dollar curve, you see low interest rates. You see inverted curves that are basically saying we're going to have a very slow growth, potentially volatile and slow growth economy going forward. So depends on
if
what
you had to guess,
why
is that? I think that's a good. There just does seem there's a weird disconnect where some of these things look very bullish and some look very bad. It seems like there's a huge spread in just the general sense of the word of and I guess that makes sense, right? The possible variance of outcomes here is extremely large, right? It could be extremely bullish. We had a short-term demand shock. All that demand didn't get destroyed. It got deferred. The person that didn't take a vacation in April is going to take that vacation in June. So that's going to show back up in GDP, and the Fed and Treasury injects a ton of money in the capital. So great, that's super bullish. And the flip side is how long does the virus take? What if things stay shut down for a year and blah blah blah. I don't have a good answer, but how do you square those? How do you think about
It's hard. I agree with you, man. You can you're the vol guy, right? And you get a fund that's going to be investing in that product. And I feel like there is a lot of scenarios that you can see, and lots of money is being bet on both sides of the scenario. Like I just said, in the corporate bond side of things, you're seeing some of the biggest weekly issuances of new corporate bonds in history. So people taking risk, money coming into the credit market, or into companies via the credit market, via loans, bonds, etc. And then at the same time, I just saw a Bank of America fund manager survey the other day where retail cash levels are at the highest they've been since I don't know. I have the chart somewhere, but since the last crisis. So retail cash is at all-time highs, and then you've got the money market accounts, which is institutional cash, institutional investors that are if you look at government money market funds, so government backed, so money market funds that invest in government securities, those funds are roofing too. So yeah, you've got two ends of the spectrum of risk on folks, people, risk on investors, super risk off investors. And yeah, one of them is wrong. And I don't know, you don't know. So the bull case is that, this thing is one-off in nature. There's a ton of cash on the sidelines, both on the retail side and institutionally. That money comes flooding in aggressively, along with this Fed backstop, along with all these different programs that are there, and money printing, and that could be extremely positive for asset prices and potentially inflation, especially if there's a supply side disruption. At the same time, this new credit that came into the markets via the bond markets, again, like you were saying before, Taylor, if credit market starts to turn and say, screw this, we're not buying these bonds, or we're going to sell these bonds, we're going to, spreads start to blow out again, that's a problem, because there's now more leverage in the system via a lot of these loans and bonds that have been purchased and issued. So, you can paint draconian scenarios, you can paint super bullish scenarios too. And this isn't to hedge everything. It's just, it's not, if anyone had a crystal ball, I guess we'd all be gajillionaires.
That would be nice. What you mentioned, like inflation. I'm wondering, like, because I know the last time we were talking with Erik, we were talking about inflation and sort of like post 2008, or in 2008 there was like I think that was like a big narrative, right? Like the Fed is printing all this money, we're going to see inflation. It seems like, I guess the theory that makes the most sense to me, which may or may not be true, is that you explained to me was inflation needs to just been in asset prices, right? Because of the way that money came into the system. We have seen asset price inflation since 2009 with stocks, bonds, real estate, et cetera. Like what makes you think, like what makes you think like this would be any different? Like why would this show up in inflation in the way we typically think about it in terms of like consumer price inflation? I don't know.
Honestly, I don't know. I can't point to a ton that would make it that different. I mean, I guess one thing is, they're doing these, there's some stimulus checks that are going out to people. Again, they're so small. I mean, $1,200 or whatever the number is. They're doing a lot of small business loans, which is keeping people employed, which, is good. Again, I think that bazooka is going to have to grow too, because I think there's going to have to, give more money to the people, if you will, versus, the institutions. But that said, as it stands now, I don't see there being a ton of difference. The other big thing I guess you could say is there's potential for supply chain disruption, which could affect the supply side of things, in terms of products, goods, et cetera, production. I mean, you even saw it on a mini example, like go try to, I mean, I don't know if now, but, a month ago, to go try to buy Purell. See what you see. I went to my local bodega down the street, and they were trying to sell me it for $24. It was like some ridiculous number. And it's like, if that happens across the board, you're seeing what's happening with Smithfield Foods right now in South Dakota. They're shutting down plants. Again, I don't know what's happening in meat prices at this point, but if you start to see crazy supply disruptions, well, that could cause, consumer prices, for goods to increase. Don't know if that affects wages though, which is the real thing that matters, where then, that starts to affect Main Street, because the examples I just gave, supply disruptions actually hurt Main Street because prices go up for them. If they're offset by wage gains or greater wage gains than the prices that they have to pay for goods, well, then they net benefit because the wages went up more than the prices that they're having to pay for goods. But if you see just the prices of goods go up and wage gains don't, that's problematic. And, so to answer your question, as it stands now, I don't see why this would be that much different. I think this is, if anything, these programs are extremely supportive of asset prices, potentially supportive of asset inflation. Don't think, there's enough kind of going to Main Street that's going to really, help wage growth really kind of exceed inflation on a material basis. Again, I'm not an econometric guy, but like it just seems like there's just not much. You're seeing furloughs. You're seeing there's some PPP stuff that's coming in that's helping out with that, but like so people are getting to keep their jobs versus lose them maybe. But like to really see wage growth, which is what is important to help the kind of average Joe. It's hard to see that happening without asset prices increasing as well.
I think things have gotten like hairy there. I guess that's the question. Like, what do you have a sense for like what's going on there? Like, at what point does like that start to crack, and what does that look like?
I don't have, the exact numbers, and there's always delays on when you get all those, but I did read an article, like, I don't know when it was, last week or something like that, that CalPERS lost something like $69 billion in March. CalPERS, the California Pension Plan, that basically, a massive drawdown. I think it was, 15% or something. I don't know. I think their assets were like 400 something billion, and they lost 69 billion or whatever the numbers are. They lost a lot, right? And so, that ain't helping them get more funded. And, CalPERS is decently funded relative to other states. I think they were like 70% funded 70 to 75% funded before that. I don't have the exact numbers, but yeah, overall states are going to likely have taken a hit again now with the market bouncing and with assets maybe bouncing again. I don't, who knows how much of that 69 billion they've made back on paper, and it's all weird accounting anyways, fuzzy math, but yeah, I mean, this is not good for the pension system overall. It will likely cause more underfunding, is my guess. At this point, if we stop right here, it would cause more underfunding. I think will cause more stress. Will potentially cause some of these states to look for federal assistance at some point, to help with these pension funds. Again, I'm not trying to use my foghorn and go nuts here, but it's just, yeah, I mean, you look at some of these states. I mean, I have a map, Taylor and Erik, I'll send it to you, but it's just some of these states. I mean, Illinois, where are they? Yeah, Illinois, 38% funded. I mean, Kentucky, 34% funded. Colorado, 47% funded. This was, again, this is from 2018 actually, so it's outdated. But the point is like, we're talking some of these states, 30, 40% funded before this. So, it's at some point something has to give. Whether they start cutting pension payouts to people, whether they start increasing taxes on in these states in order to increase distribution, increase money going into these pensions. Yeah, it's a problem, and we haven't that hasn't even arisen yet. I mean, again, the Fed is backing the muni market, which is related to this. But, that's for, things like the MTA and bonds that help with infrastructure and, tolls and these things. So it's not crazy that the Fed could ever have to come in and maybe help a statewide system like some of these pension funds. But I mean, that hasn't happened yet, and it doesn't seem to be happening at this point. But yeah, these guys are in a world of pain. I don't know. It seems like a fool's errand to even try to get out of it, without drastic measures like cutting pension payouts, which again, if you have to pay out less, you can, your funding, comes back in line a bit. But, again, what are the social consequences to cutting a fireman's pension? Guys men and women who have worked for 30 years as fire people, and they now don't get their pension, or they get their pension. They thought they were going to make, X. Now they're going to make 0.6 of X. And they just gave their heart and soul for 30 years. And, this is my unionized pension that I deserve, and, yada, yada, yada. And you get that across police stations, firemen, municipal workers across the board. And just what are the consequences of that? And what are the reactions of those people if that were to start to happen? Again, I don't want to get too crazy, but it's just, that's a mess. And, this situation has not helped it. It's hurt it. We don't know the degree. Again, I'm using one data point of CalPERS losing $69 billion in 1 month on paper, as kind of, again, there's other data out there with other funds showing poor returns too, but it's definitely not getting better. And the only reconciliation I see is either, like I said before, cutting of some of these programs, raising taxes in these states and cities to, bring more money into these pension systems, or, God forbid, a Fed bailout, which, may have to happen at some point.
Right. It almost seems like that's the most politically tenable option. Like, you can't, like, cutting the, aside from like the ethics of things, like what's politically feasible, like cutting all the payments to like all the teachers, firefighters, policemen, whatever, like that's a huge voting block. I assume that's very unpopular. Like raising taxes, also very unpopular. I mean, I don't know the dynamics of like what it takes like to get the Fed involved or whatever, but yeah, it doesn't there doesn't seem like any easy solutions. And like considering they're already significantly underfunded last year, which, should have been kind of the best of times, so to speak, from an asset price perspective. Like, what does that look like going forward? And I was thinking this idea of like, volatility cannot be destroyed, only transmuted. Like, we have, we take volatility and we take volatility out of certain systems, and we inject them into other systems. And like maybe what we're seeing right now is something like where and sort of attempting to not destroy, but attempting to contain or reduce volatility in sort of like the economic, finance, asset price sphere. Like, are we just transmuting that volatility into, the social sphere or the political sphere or something else like that? And it's kind of like a nebulous idea, but it does seem to some extent like that's happening.
Yeah, no, I think that makes sense. I think you said something the other day on Twitter about like, we could see, the social unrest we've seen or whatever in the last 20 years is nothing compared to what we potentially could see, and that it all flows into that. And yeah, I mean, it's the same thing that could potentially happen with all this stimulus, where yet again, if we get asset prices kind of skyrocketing and, asset inflation, and then wages continue to stagnate, and, people are getting fired and people are getting furloughed and people are losing their jobs, and the economy, and these, food banks are being drawn upon, continuously, and it slogs on like that, you're going to get, yeah, exactly. You're going to get some sort of social backlash again. I hopefully, sorry, go ahead.
No, so the dynamic's interesting with the whole COVID situation, because I mean, this particular scenario disproportionately affects like people that need to go to a physical location to work, right? Like if you're primarily doing like some form of white collar work where, your work is like spreadsheets and Word docs and emails and a phone, like, it doesn't matter, like, whatever, you're sitting on your couch and your kids are running around, and like, that's, it's a bit harder whatever than going to the office, but like if you work at a factory or restaurant or like whatever, like you literally can't, the government has mandated that you can't go to your job. I mean, that dichotomy there is just like, I don't know, it's expanding on what you were saying in the sense of like, the people that own the assets are also the ones that are least affected, right? Like they're getting the best deal on two levels, or, the other way, people that are getting shafted on two levels.
The Zoom class. Yeah. The Zoom class like gets, the Zoom and Slack class get to work from home and order their Grubhub and, do these things, and good for them. It's good. It's very fortunate to be able to do that. The plumber doesn't get to do that. The waitress doesn't get to do that. So yeah, it's tricky. It's really tricky, and everyone's got different financial situations and everyone's got different setups. But yeah, the guy sitting at home on Zoom and Slack and Grubhub in his sweatpants, quote unquote working, getting a salary, he's in less of a hurry than the waitress to get back to work, let's say. So, yeah, who knows what that means. And then you get even another layer where it's like, with these programs like the Paycheck Protection Program, the PPP, like that's already been tapped in a week, right? So that thing's tapped. Now, again, I think they're going to re-up it. I think they're going to, increase it so that something, that more people get the loans. But like, what if you didn't apply in the first day that these applications became available? You waited 4 days to apply, and because you waited 4 days, you didn't get the loan as a small business. And but the other guy that did it, at 12:01 a.m. on the night of the morning of the, like he got it, and you didn't because you waited 4 days for some, it's like you get like bitterness and resentment.
Yeah. And I was thinking about that last night. I've talked to a bunch of small business owners this week, basically. And like, I something like, I would guess like, just my personal sampled bias, people I know that run small businesses, like maybe 10 to 20% got it. And like, it looks completely arbitrary. Like the people that got it, like if you had, it seems like, it was like, if you were close to the money in the sense of like, usually like if you were at a small bank or you had some pre-existing relationship with a banker person that could like push your application to the top of the pile, like those people got it. Or it was just some arbitrary thing. Like everyone I know that banks at Chase didn't get it. Like Chase just like didn't, I guess whatever their back office, they like didn't do it. Whereas like if people that went through PayPal, it was like much higher. But it's, people are like frustrated because it does feel completely arbitrary, right? It's not like the 20% of people that needed it the most got it. It's just like the 20% of people that like apply, that knew how to work the system and da-da-da. And I guess that kind of strikes me as like a microcosm of like what a lot of other people are feeling, right? Like it just feels all arbitrary and no sense of like meritocracy or whatever in terms of like how this is getting done. Like it's, did you know the right people and
Yeah. I mean, you could say on some level, the people that acted quicker and they're more aggressive, and so they got it. They got the loan because they got it in there first, and so there's like maybe like some merit in that, but like not enough to like have the program run out because you were 4 days later than the other guy, and then what you're talking about where it's literally wink wink favors for people for existing clients. I heard there's a theory, probably a conspiracy theory, that Chase and some of these bigger banks moved slow on purpose because they wanted the funds to kind of get drained via other banks because they didn't want to deal with all this administrative stuff. And so, Chase in particular, I've heard that about. Again, who knows? But it seems like the smaller banks worked better for this.
Let's go deeper into the Eurodollar market. Say more about what's going on there, and maybe you can get into dollar milkshake theory a bit.
The Eurodollar market is, arguably the biggest, most liquid, heavily traded futures market in the world. Historically, people think about Eurodollars as kind of offshore U.S. deposits, or U.S. dollar denominated deposits in foreign banks. But it's more than that. It's a very the most liquid, the most heavily traded futures market out there. Mostly money market funds trade these, and what bigger picture what they are for the most part. The investors, the money market funds are very close to the economy, and so they're very sensitive. And so what I guess that the takeaway from this market is watching what's going on from the players and the price action in this market is very important, because arguably the players in that market are as close to reality or economic reality as possible. And so there's something you can look at, kind of a Eurodollar curve that basically is like a yield curve, right? So you've got the treasury yield curve. Is just the x-axis is time, and the y-axis is yield, and you've got a similar thing with the Eurodollar market. And it's right now it's pretty inverted, meaning nearer term rates are higher than kind of out months, and then it starts to slope back up again. It's kind of like a smirk of a smile, but it's like it starts high and then it goes down, and then I can send you a picture at some point. It starts high and then it goes down for like 12 months, 24 months, and then it starts to like slowly pick back up. But what it's basically saying is that, rates are going lower in the near to intermediate term. The market participants in the most liquid market in the world, the most heavily traded market in the world, by the people who are the closest to the economy, are basically saying, rates are going to be lower. Growth is going to be very slow in the short and intermediate term, and then our recovery is going to be relatively prolonged as well over the next 5 or 10 years. Again, that this is based on Eurodollar future trading that is happening across all tenors on the curve, that is implying the curve, and it's just right now it's not speaking to Goldilocks. It's not saying rates are going to be go back up a lot quickly because growth is going to pick back up. Usually, when growth is really high, interest rates are high. I mean, that's generally a correlation. What it's saying is that interest rates are going to be low in the short and intermediate term, and they're going to stay there for a bit, and then they're slowly going to go back up again, which to me reads that they're saying things are going to be very slow growth-wise in the short and intermediate term, and then we're going to slowly start to come out of that at some point. So that's another thing that's a little bit, I don't want to use your word, Taylor, I like it wonky. It's just like, you look at certain markets and, valuations are high and, they're implying pretty high growth, et cetera, but you look at the Eurodollar market, which is, again, I keep saying it, the very, very, biggest players in the world are saying, no, it's going to be slow. It's going to be volatile likely as well. And we're not just going to see some V-shaped recovery.
Taylor, do you want to get into dollar milkshake theory?
Yeah, I've heard people talk about this. I was hoping to get Gabe's thoughts. My understanding of what basically the idea behind the dollar milkshake theory, as it sort of relates to the Eurodollar market, is that as you have all these central banks around the world that are adding liquidity to the system and printing that money, a lot of that liquidity injection is actually getting sucked up into the dollar, partially because of just huge demand for U.S. dollars, as Gabe said, like whatever insane amount of money is U.S. dollar denominated debt that needs to get paid back in U.S. dollars, and then compared, I guess what the U.S. is now at 0% interest rate, which is I guess relatively high compared to most other places are negative. The ECB is negative at this point, and so like that money is going to flow into dollars and strengthen the dollar. And I've heard people talk about this, but I have a consultant contractor person I've worked with for a few years, and they're based in Australia, and I pay them every month using TransferWise. And like I think in the last 6 months or something, like in Australian dollars, the amount I'm paying them has gone up like 30% or something, just because the U.S. dollar has gotten so much stronger relative to the Australian dollar. So I guess that note is like very interesting, because like we're talking about people are QE and inflation and U.S. dollar and blah blah blah. And it's like maybe actually the medium term implication is like all the money printing actually makes the U.S. dollar much stronger, right? Like all that global money printing gets sucked up as increased demand for dollars, and the dollar strength relative to other currencies rises.
Yeah, it's interesting. I've never heard that theory before. I don't know. It sounds like I should have heard of something like that before, but it makes sense. And I know everyone, there's an opinion on this, and there's a dollar shortage out there, which I think that flows exactly into what you're talking about a little bit. Foreign demand for U.S. dollars is so high, and that's what's causing the strength. And, to me, I just think about the U.S. dollar as kind of the tallest midget, relative. It's sad, dollar hegemony, where we're the reserve currency of the world, and that's us. So I think that's a function of that as well. But I guess you like you said, you get the ECB and the Bank of Japan and the Bank of England and every freaking country printing money across the board, and not to mention like the Argentinas of the world. The dollar looks pretty sweet relatively speaking. Again, what could cause a paradigm shift for the dollar to lose its dominance? Again, we could do a 3-hour podcast on that with smarter guests than me. But that's I think what you're saying makes sense, Taylor. Although there's so many moving parts to that one. I don't know.
No, totally. With all this stuff, I guess that's what I keep thinking, going back to like your earlier point of like people rushing into the bond market and now the commercial paper market and all that. Like it just seems like the variance and outcomes, like the cone of future possibilities is just like really high, which it makes sense. Like that's why volatility is kind of like the market's way of throwing up its hands and saying like, I don't know what's going to happen, right? Like volatility, when the future seems very certain, volatility is very low, and vice versa.
Yeah, and I think you brought up the point about vol, kind of going from 80 down to 40 or whatever it was, and just it kind of roofed, and it went to 80, and I don't know where it is right now. It's in the 30s, I think, high 30s. But it's crazy. I think. You asked the question earlier, like why hasn't the vol persisted? And other people have said that to me too. Like, and my argument is it's still in the 30s, it's still in the 40s. We were talking about it. You can still, there's still, options are still not cheap, for the most part. And I think when you're comparing it to 80, yes, but when you're comparing it to an average VIX of 18 or whatever it is over history, it's still pretty elevated. And I think that's, speaks to your point. And that's after the market's already gone up, a lot from the lows. So, we're in a situation where VIX vol is still elevated, relatively speaking, to long-term historical, it's well off the near-term historical price levels. But the market's gone up a lot, and here we still are. And so, I think to your point, the market's saying the tails are still relatively fat at this point.
Yeah. Has this been a win for in the MMT argument, or a sort of a pro on the MMT side? Let's get into sort of the MMT Austrian debate a little bit. Like, and have we learned anything about Bitcoin, or not learned about anything about how it operates as a result of this?
It's funny. The MMT thing is I'm not that up to speed on it. I know there's books written on it and all these things, and I know generally what it is. And again, I think people can, to Taylor's point earlier, like, look, printing a bunch of money, QE last time didn't cause a ton of inflation, and look what happens. That's a thesis, and that's, again, I think the sample size is not that great, even though, yes, it's been 10 years of kind of these things. I think when you're talking about, something, inflationary, that's a longer term conversation. But yeah, I mean, I think you're going to start to hear that. I mean, you're going to start to hear, some of this stuff that we're talking about echoes it. You're talking about direct deposits to people's accounts. You're talking about, giving people money back, making people whole, all these things that, just kind of are extremely costly. And, that doesn't even bring in the whole deficit side of things, which again is, that seems like also like a fool's errand. But I think MMT is going to be a big part of the conversation going forward, or some derivative of it. As right now, what we're seeing, it's just you can just dismiss it. It's like, the thing I keep thinking about is the student loan situation, where I think the number is like $1.6 trillion in student loans. People, you just forgive them. What's another 1.4 trillion on top of the rest of this thing? Let's forgive every student loan. Like, let's just do it. Like, why not? Like, we're just adding on top. Think of what that would do for people, and then think about what it would do for others. But like, just add it on top. Why not? Let's just bail out Illinois' pension fund. It's fine. It's just another X trillion dollars. Like, I feel like those are the conversations that could be had, to your point, Erik, that, MMT, could very likely be, or some version of it, a thing in the not so distant future. And as pertains to Bitcoin. Oh, sorry, go ahead, Taylor, you go.
I was going to sound MMT, and I'll let you get into Bitcoin. Like, it does feel like this kind of like pulled it, like, it was already in the Overton window, but now it just feels like it's like squarely in the middle of the Overton window kind of now. Like, it's easier to talk about in a way that it wasn't from just a political perspective or whatever. But I heard an interesting anecdote. Someone, I think on Twitter, was saying, like, Trump was like very insistent on, he wanted his signature to be on all the checks that got mailed out to people, which is like twisted and like a pretty sad in a lot of ways, but like politically actually very smart, right? Like, who you're sitting at home, your job's gone, and you get this big check, or not a big check, but you get a $1,200 check that just says, Donald Trump on it. Like, oh yeah, I love that guy, right? Like, he sent me $1,200. Like, what's not to like about this kind of, like, the politics of it? Like, yeah, like, who doesn't like free money? Like, you definitely get votes. Like, there's no way giving people free money doesn't get you votes.
Totally. Couldn't agree more with that.
What were you saying about Bitcoin, Gabe?
Oh yeah, I just that it's held up relatively well in the context, Erik. That we've had a relatively volatile last 3 months. Bitcoin's always volatile. Goes from 3,000 to 13,000 and then back to 6,000. And, and so I think most Bitcoin investors, traders, et cetera, know that. But the fact that it's kind of holding up, and I think the value proposition of it, again, I don't think it's in the store of value stage of money yet. I think it's got a lot of characteristics that make it a good store of value over time, yada, yada, yada. But like, we're not there yet. It's still right now a very speculative asset. It's, arguably the tip of the spear of kind of risk assets, in the venture capital side of things. Again, for people like us who've studied it pretty closely, I see the value proposition of it not being as speculative as the average Joe that looks at Bitcoin and like, whoa, this thing's crazy volatile. Like, to me, the volatility is the price of admission to, an asset that, could go up 10, 20, 50x over time, and is a scarce asset, has the characteristics of a strong store of value. So I think you're starting to see some of those qualities, slightly shine through, throughout this, But, listen, it did go down to whatever it was. I don't know where the low it went to back to 4,000 or whatever it was, but there's some crazy stuff going on in leverage and BitMEX and all these other things. But here we are back up at 7,000 again. The point is it didn't go down to $10, which, if it was truly a piece of junk and you wanted liquidity, it's easy to sell this thing down, and it could have gotten sold down, and it didn't. So I think it's another not chink in the armor, the opposite of it. It just shows its strength. It shows its anti-fragility potential. I think if anything, it makes me more bullish on Bitcoin. What do you guys think?
Yeah, I just pulled up the chart. Bitcoin is down 3.8% year to date, and the S&P is down 10 or 12%. So it's year to date is held its value better than yes. I just, if you'd asked me, let's see, if you'd asked imagine the S&P is down 20%, how much is Bitcoin down? I would have guessed 40, 50, 60 or something, some multiple of that. So yeah, I guess considering that does seem, and I know I've talked to you, I don't know what your sense on this, Gabe, is. I know we've talked about it before, but part of the question is to what extent, I guess part of what we saw in March was a liquidity crisis, like gold, bonds, stock, everything was getting sold for cash. People just needed cash. And so the question is to what extent do the holders of Bitcoin hold sort of other assets where in the liquidity crunch, they would have to sort of indiscriminately sell their Bitcoin as much as anything else? Or is it is it mostly is the investor base kind of distinct from, the investor base in most traditional asset classes, such that you could have a liquidity crisis in credit markets or whatever, but not see that in Bitcoin? I don't know. I think it's probably impossible to actually get that precise data.
Yeah, I think it's hard to know too. But I think anecdotally, right? We've been talking about for how long as if people have been talking about the institutions are coming, the herd's coming. They're coming, and then they don't come. And a lot of these institutions, if you think about it, I think it's more than it was a year ago and 2 years ago, of course, but. We're still, most people don't own this asset. Most institutions don't own this asset. Most institutions can't even trade this asset. So to that end, it's got a lot of retail support. So you could say, if the economy goes bad, and people need to put food on the table, of course they're going to sell Bitcoin, just like they're going to sell gold. They're going to sell anything they'll make, that's liquid. But I think this probably has a stronger holder base overall. Retail wise than stock market investors. Institutionally though, I don't know if you have that issue where you're saying, where a bunch of institutions are forced to sell stuff. And so they're going to force sell Bitcoin. Again, they don't own it to sell it yet. So perhaps that's what we're seeing too. But I'm sure they'll come in when it's much higher.
I want to go to the, back to the stock market for a second. I heard this one theory that, maybe the S&P isn't hit as much now as opposed to after 2008 because of QE and because of low interest rates. Maybe S&P is sort of the new savings account. People don't want to put their money in banks will get low interest rates or even inflated away, and maybe the S&P is the safest thing relative to the other options. What do you think about that theory? And then I'm also curious just to get your understanding of what is the impact or the sort of ratio between retail and institutional decision making as it relates to the stock market generally? Is it mostly an institutional phenomenon? Is it mostly a reflection of what institutions are thinking, or a reflection of what retail investors are thinking and doing?
Yeah, the first one, I don't know. I haven't heard that about the people using the stock market as a savings account. Super aggressive to think in that format. I don't know, maybe you got the Robin Hood kind of effect or something like that, where younger people are doing that or something perhaps. And with the market kind of, again, as the millennials or whatever the generation you want to call it, over the last 10 years, this thing can't go down. It doesn't go down. Look what happens. I can just put it in the stock market and it's like a savings account. And if that reflexive kind of attitude prevailed, then I guess it's possible that could be the case. That's kind of scary to think about, given there is risk in markets. I think this shows, the last 3 months has showed us that been a big wake up call for the kind of buy the dip folks, perhaps, especially the levered ones. At the same time, I don't know. That's an interesting paradigm to think about. I don't know anyone who thinks about the stock market as a savings account, but I guess it wouldn't be shocking to think that many people would think that, given kind of the relatively low volatility we've experienced the past.
Like, and I guess I think about it too in terms of like the whole sort of like passive investing bogleheads phenomena. And I was looking at some data, like the 401k flows into like Vanguard in March were like unaffected. So it was like, as you know, the selling wasn't coming from like retail investors in their 401ks panicking and like selling their index funds at Vanguard. It's just like, you know, I deposit X% of my paycheck every month into my Vanguard account and buy the S&P 500 index fund or whatever it is. And like those flows have been relatively unchained. But I guess I worry about it. I think about it in terms of like if you look like the period basically from like 1984 to present in terms of like equity prices is like U.S. equity prices 1984 to February 2019 is like basically to my knowledge, basically the best run of equities in any country in any history. Of all of history forever. And so there is kind of this like almost, it seems like this mythology built up around like that's, equities, go up forever and everyone can just save their money in equities because like maybe it'll go down, but it'll be back in like 2 years. And like, there are a number of, 20-year periods. The Dow Jones index was flat from like 1963 to 1983, right? And how many people that save money in their retirement account are like prepared that like a possible situation is like that account will not increase or will not get, it will be at that value or lower, for the next 2 decades. Like my sense is like very few people that are doing that, like think about it in those terms. Like the idea of like like you almost can't say bad things about like passive investing. Like it's such like a moral good in some ways, which inclines me to think like, there are like bubble aspects. Like just the fact that you can't talk about maybe this isn't a good idea, like makes me quite nervous. Like the fact that it's almost like, again, out of the Overton window to even say like, maybe like sticking all your money in an S&P index fund and like assuming it's going to go up 7% a year every year or whatever is like not an appropriate way to think about saving for retirement or saving for your kids' college or whatever it is.
Well, yeah. Well, it's interesting on that note. Yeah, I think I agree with you. I think recency bias is a huge thing, and I think that we're talking about you just talked about 30 years. I was talking about over 10 years. Yeah, I think recency bias can play a lot into people's thinking, including myself. But yeah, with regards to the 401k stuff, I mean, I think Mike Green, I think he talked about it where it was like, there's no outflows. It's just inflows into your 401k from your paychecks that then go buy oftentimes ETFs and other passive instruments. Yes, at some point there's going to be outflows via baby boomers, older people that are starting to take distributions. Hopefully not young people, because then they're going to have to pay fees and penalties. But yeah, like it's not surprising. The data, I guess, is my point, is that flows in from 401ks are generally speaking just they're going into the market. They're going into these assets because, people are on auto pay or on auto whatever withdrawal from their own paycheck that then flows in there. So, again, that's part of the whole kind of speculative, potential of, passive investing bubble, because they're indiscriminately buying and indiscriminately allocating to these things, regardless of where they are in price. I mean, which again, you could say, well, that's like dollar cost averaging or something like that. And there's merit in that too. But yeah.
And that's a question too, like how much of the growth in equities is like just demographics. Like, as you said, like the flows are all in. So like in practice, like these, like if you're, Vanguard is not just like, it's just a constant bid, right? Like if people every month take money out of their paycheck and put it in Vanguard and buy the S&P index, like that's a bid in the market to buy every stock in the S&P index that has to happen. And so like at some point those flows like probably reverse, right? Like the baby boomers retire and the money starts coming out. So yeah, I've heard Mike Green I've heard talk about that the most as well. Like, and that, it was in sort of Q4 2018, we saw that volatility I think, December 24th and December 26th, the market was down. The Dow Jones was down 1,000 points from the 24th and up 1,000 points from the 26th or something like that. But that interesting data point there was those were the only 2 days, or the first 2 days in history, where every stock in the index had gone up or down on the same day. So typically, you might have the index overall be down, but I guess that was interesting. Is to what extent that suggested a lot of that is passive flows, right? Maybe that, and you have to take distributions. Is after 70 and a half years old, you have to take certain distributions. There was speculation, like you said, was that just all these baby boomers? That was the first wave of them having to sell their whatever's in their 401ks or IRAs to take whatever the minimum required distribution is, and we look at the demographic curve, and I can't remember exactly where that peaks, but it's late 2020. The baby boomers peak in 2028 or 2030 or something like that.
That's interesting. Yeah, no, I don't. Yeah, I haven't dug into the details on that one, but yeah, to circle back to your other question, Erik, about who drives the market prices, or is it an institution, is it retail, is it whatever? I guess I would add another player, and this actually flows into all, circles back to a lot of what we're talking about, is the biggest player in the markets the last 10 years has been companies. So there's all this fear over company buybacks, and companies are buying all this stock, and Delta Airlines, how could they do that? All that stuff. But the company buybacks have been the biggest driver of prices, and the biggest buyer in the market by an order of magnitude. And that is another scenario and another situation that's worth monitoring here, because now you're getting companies that are needing bailouts, and the Delta Airlines again is this quintessential example. It's easy to pick on them because they bought back whatever X billions of dollars of stock over the past 10 years. Now they're asking for that much exactly in bailout funds, and it's just cruel irony. But what happens to buybacks what happens to the market when there's no corporate bid, or very little corporate buyback bid in place? That was, again, the major fuel, along with what Taylor's talking about, this kind of auto buying from passive stuff. But these company buybacks have been hugely inflow to equities. So what happens with regulation around that going forward? So that's worth monitoring. What happens if they start to they ban buybacks because we can't just because they can, because listen, you guys are taking bailouts from us, you can't buy back stock. Well, now it's super unfair to the company that didn't take a bailout, or if a company didn't take a bailout, they could still buy back stock. But is that fair too? So maybe they just ban stock buybacks altogether. Again, I'm making that up, but I'm just saying that what happens with those? Right now, there's going to be stigmas attached to buybacks because of look what happened last time, and you bought back stock, and now now this what happened. This can happen, and what does that look like? And then moreover, I think we're going to start to see the opposite of buybacks. I think we're going to start to see secondary equity offerings, which again, is a point for the bears to make that not only is the buyback bid gone, the buyback supply is there now. So, excuse me, the corporate stock supply is there. So, they're going to be doing secondary offerings in order to raise capital because of what they're dealing with right now. And so, that's a whole nother dynamic that I think is going to be super interesting, given how important stock buybacks were, to companies, to markets, and the influence they had on prices, Erik. So I think to your question before, I think the stocks, that's the biggest thing I'm watching. Whether the institutions and the retail, that's just important. I think on the margin, I think like I said before, cash, big extreme, cash balances, high cash balances on the retail side is generally a contrarian indicator, and you generally want to be buying stocks when high cash levels on the retail side get super extreme, and vice versa when the high cash level, or when cash levels get super low for retail, that can maybe make you a little more cautious. But again, I think the bigger factor is what happens on the corporate side of things, because I don't think that's talked about enough. Just because we haven't really seen any stock offerings yet. We've seen some, and we've seen a lot of bond offerings, but we have not seen price discovery yet via the equity market. And again, I think that just could be a headwind going forward, especially as prices bounce back. Now companies are like, oh shoot, maybe I should sell some stock here to kind of shore things up a little bit, get the cash reserves higher, or hire more people, or invest in growth projects, whatever it is. But I think that's something we're gonna have to watch.
And what's the best way to make sense of sort of the stigma as it relates to buyback? Like, what's your opinion on it, or just bailouts in general? Too, I mean, we had Chamath sort of go viral the other week for saying that we shouldn't bail out the airlines, and he also sort of explained that it wouldn't hurt employees as much as we think it would, and that it would hurt the sort of investors / speculators. How do you make sense of this, and what's your opinion?
I mean, I think his opinion is aggressive, and I think that lacks nuance. To say that it doesn't hurt employees because again, I'm not a bankruptcy expert whatsoever. I'm sure he knows a lot more than me. He can quote the friggin' rules and all that stuff. But the point is that yes, I agree on some level. I am like, just let it fail. This is capital markets. This is markets. Markets don't always go up. People don't always make money. You underwrote the risk. You took the risk. You now you have to take the pain because you made a bad investment. And so, I'm sorry, Mr. Family Office rich guy, you lose. But and then he's saying that, well, because even in bankruptcy, there's a process. They get their packages, and they keep X amount of the employees. But it's still not simple. A lot of those guys have a lot of employees do own stock, so it hurts them, and lots of employees lose their jobs as well, and take pay cuts, and there's restructures, and so. I don't know the exact right answer. The part of me is like, totally on the same page. Like, yeah, this is just the natural kind of process of capitalism. And, there's winners, there's losers, there's risk, there's reward. And this is a time when, people can lose, and let the people lose. Don't just bail them out. And at the same time, I don't think it's so simple to say that let them all lose, let the stocks all go to zero, and it's not going to have any effect on the employees because there's some process and some package that allows them to kind of stay in place. Because I don't think that's how it goes most of the time. I think there's a lot of pain taken by employees in those situations as well.
And so we saw some of this in 2000. Gabe, you correct me if I'm wrong. Like part of the problem in 2008 was you had to get the banks to agree to take the bailouts. If the deal for the bailout is we keep all the employees, but we wipe all the equity shareholders, the management that owns a bunch of equity might as well just run the company into the ground at that point, because why would they take the bailout that wipes out 95% of their net worth, or whatever they have tied up in the company. So I don't know. I don't know anything about bankruptcy law effectively, but yeah, you do have, my understanding is Chapter 11 bankruptcy, you do have significant impact on the employees, but finding a way to do it that that I guess morally that seems maybe the Schelling point, or what people are thinking, oh, okay, equity holders took risk and they got buybacks, and now they should lose their money. Logistically, even I don't know if that's even the right approach, but let's say it is. How do you actually make that happen? It's that seems like a really sticky problem.
No, it is. And it is, you brought up a good word, moral, and there's just, so much of this stuff is just, moral hazard 101 across the board, incentives not being aligned, or, even the buybacks is a perfect example of that, where management's compensation is literally based on the stock price in a lot of cases. So why, they're incentivized to be buying back stock versus, doing new projects versus hiring employees versus, growth capital, et cetera. Let's buy back shares and get the stock price higher. And, that's, huge moral hazard. And then you brought up one just now, in a bankruptcy process and a discussion, like you said, for a bailout, how is management going to act? Are they really acting in the best interest of not themselves? And it's tricky, man. It's all, incentives are powerful.
What have we not spoken about here that you think is important that people know if they want to understand what's happening in markets right now, or important to think about moving forward?
Yeah, I think one thing, I think I kind of talked about it before, is just kind of thinking about what are the behavioral changes? I know there's like tweet storms and such about this, but like, what are the behavioral, like long-term behavioral changes? Like I'm kind of in the opinion that like most people are going to have short memories. And if this thing is just, ends up not being the biggest deal in the world in short term, people are going to kind of go back about their business as they once were for the most part. But it could last much longer. It could be more long-standing, yada, yada, yada. And B, I could be wrong. And, there could be some serious paradigm shifts, some serious behavioral changes that come from this. And I guess that's something I don't know the answer to, but it's something I'm super curious and I'm going to be studying very closely going forward, is just like, how are people living in the world differently or similarly than they were kind of before all this stuff. And then what are the effects of that, both economically, socially, I guess politically as well, because, they're all intertwined in this day and age. But that's something that I'm going to be watching pretty closely.
Is the Fed buying junk bonds significant?
It's significant. I mean, they're again, according to their program, they are buying. Their primary objective is to buy investment grade, and then I think with the rest of the proceeds, they're going to be buying, or they're allocating X amount. And it's all vague, I think, but they're going to be buying mostly investment grade, and then with the remainder, they're going to be buying junk ETFs, probably bonds too directly. I do think it's significant. I think it's as significant. Well, there's a couple things. It's significant from a signaling perspective because, again, similar to backstopping, this market and that market and this market and that market, it provides a signal to the market that we're here. So perhaps other market participants, come in and support it, and so it's not just the Fed standing there with their hands, their bags getting fat because everyone's selling to them. Hopefully that's not what happens. But, it sounds like even if it does, their bags are pretty big they have a pretty big bid. So I think it's significant from that perspective. I think, again, we talk about moral hazard. There's an argument to be made that it's, reinforcing bad behavior in the sense that these are highly levered, highly speculative, highly risky industries with, arguably bad businesses, bad capital structures. I don't bad management maybe. I don't know, but like not great, companies. They're high yield, high risk companies. That may or may not deserve to be in business, regardless, without subsidies. So, why support these kind of, I don't know, zombies an extreme word, but why support zombie companies, that really are kind of uneconomic, that have poor unit economics, that have poor, operating leverage, that literally have, sub, 5% return on invested capital, these things, why support these things when, you could forgive student loans, you could give more money to Joe Main Street, et cetera. So not to go off on too much of a tangent, but yeah, when they start buying the junk of the junk of the junk, it's just like, we can't let anything fail ever. Is it really, is everything, even the most, poorly run, highly speculative things need to be saved? That's the question. So I think it's questionable. But it's a bit of a cynical take there.
It's said that throughout all our crises, the Fed sort of improves over time. It learns, it tinkers, and we get smarter. Do you feel like? And one critique of 2008 was we didn't act, big enough, fast enough. Do you think that's both I guess monetary policy and fiscal policy? Do you think that's happening here? Like, should we be happy with the way that we're handling this, the Fed or the Treasury?
I would say as it sits right now, I think again, they had a bit of a playbook. I agree with exactly what you just said. All these acronyms we just talked about, the CPFF, the PDCF, all the alphabet soup of facilities that are in place right now. A lot of them, TALF, et cetera, came from the last crisis, and Bernanke, those guys, they set these things up. So they had a bit of a playbook. They've added some other stuff, obviously, some other programs. I think, like you said, they've iterated and learned. So I think as of now, they're where it stands right now, they're doing a good job, in so much that you believe that they can actually control things. Again, that's this whole infallible Fed, thesis that, they can just control things. They're in control. They're really in control. And, all it takes is to look back and watch Bernanke talk about how we think subprime is contained, 6 months before everything unwound crazy. And, Jay Powell, I'm sure we can find some quotes of his saying, yeah, we think things are great right now. And then, 3 months later, here we are. So I again, that's tongue in cheek, but I think, there is a lot that they're doing. And I think they are really backing up the truck and doing what they can here. The question is it going to be enough? And again, as I was saying before, some markets are saying no. Some markets are saying, the commercial paper markets, maybe the Eurodollar markets, even the treasury markets, the spreads are pretty wide right now in terms of the markets for the bonds. So, certain markets are not saying it's enough. They're not, kind of coming correct and kind of reverting as maybe they should, given the bazooka that's being thrown. So that's the kind of tricky thing, is that even though there's so much being thrown, and I think that they're doing a good job, I still think there's going to be more on the come. I don't know exactly the path, how that looks, but I think that they know that they need to continue to come correct, and they're going to need to re-up the PPP. Well, it's not the Fed really. It's Congress. Congress knows they're going to have to re-up that, but it's. I think I would give them a B+, A- at this point. But again, I don't know if they're in full control. There's a chance that things get out of their hands, and they can throw everything they want. You can go MMT on that ass across the board, and markets are still markets, and people still need to sell, and they need to sell, and they're going to sell it down because they're going to do that, and they're going to cause this SPVs, like you're saying, Taylor, to need to request more money. If they can't get more money, then those things go bankrupt, and that's not a 0% chance either. So, I think the Fed is willing to do what they can, or think that they are willing to do what they think is good enough. I don't know. But at some point, we all might be shown look, it doesn't matter what the Fed thinks that they're doing. And as much shit as they want to throw against the wall, it's not enough, or it's not the right shit or whatever, but it's excuse my language, but it's, it just it might not be enough. And so, yeah, that's my take. Taylor, do you have any strong view on the Fed?
No, I think you said it all.
Yeah. I think that's a perfect place to wrap. We'll have to have both of you come back in around a year or so. It'll be fascinating to see, was this sort of a short-term demand shock? What's going to happen with inflation, with the pensions, with will the Fed go MMT on all our asses? It'll be fascinating how this all plays out.
It sure will be, man.
Erik.
Yeah. With that in mind, thank you both for coming to the podcast. It's been a great episode.
Thanks a ton, Erik. Appreciate it. Thanks, Taylor.
If you're an early stage entrepreneur, we'd love to hear from you. Check us out at villageglobal.vc.